From New York City for our audience worldwide, Bloomberg Real Yield starts right now. Let's get straight to it. We begin with the big issue, a monster downside surprise.
It's a big miss.
Huge surprise, highly disappointing.
We were expecting higher numbers.
Lots of questions. Is it demand or is it more likely that it is supply?
Clearly there's something going on here.
This is a supply issue, not a demand issue.
I wouldn't totally discount the demand side.
Mike is saying it is structural, so he's taking it one further step. I said it is the supply side, but it could be short-term, could be long-term.
This is what the Fed's telling us.
It will reaffirm the Fed's commitment to doing nothing.
It keeps the Fed dovish.
Joining us now is Schwab's Kathy Jones, Morgan Stanley's Jim Caron, and Jim Bianco of Bianco Research. Kathy, I'm going to go through each and every one of you to get a reason as to why we've had such a big downside surprise early this morning. Kathy, first to you.
Well, there were a number of factors at play. Seasonal adjustment, the one-off, the shortages in the chip sector, keeping some of the factories closed. But I've thought all along that we're really not going to get a robust rebound in jobs until we get the schools open again. You have a lot of parents at home working, are trying to work while they're trying to balance virtual school. They can't get full-time or affordable or available contingent health childcare to allow them to go to work. And so for some, they just have to wait it out. There's not a lot of choices. When you look at the state and local government jobs, a lot of them are education related. It's not just teachers, you've got food service workers, bus drivers, crossing guards, it multiplies, has a lot of tentacles. So I think it's going to take some time, but I think by the fall, we'll see a big improvement.
Jim Caron, your take.
Yeah, so I agree that we are going to see an improvement in jobs. But look, I mean, when you have a miss like this, I think everything has to be put on the table at this point. We had a very, very strong March jobs payroll. So a lot of the reasons that, many are using to sort of ignore this current weakness, in the April payroll number, might not hold up to March. And I know there were I know there were differences with seasonality and things like that. But, I think everything needs to be on the table. So whether it's unemployment benefits, whether it's, going back to school and figuring out, when people feel more comfortable going back into the workplace, all of these things are factors. The key here, though, is that the data right now is extremely noisy, and the risk that we all run is extrapolating noisy data points. It was wrong to extrapolate the March strong payroll number into a strong April number. It may be wrong to now take a weak number that we just got today and extrapolate that into the future as well. So very, very noisy data, and we're working out of sample given that we don't have many pandemics to really go on and see how economies reopen. So that's the key issue here. I think the data is noisy, and I don't really think it's anything more than that. There's nothing conclusive here in my view.
Jim, 2 points there, and I want to pick on the second point in just a second. Let me get to the first one, what underpins this miss. Jim Bianco, this is from Luke Cower of UBS. He writes on Twitter, Luke who? I know that's what you're thinking, formerly of Bloomberg, of course. Luke Cower of UBS, now of UBS, send the following on Twitter, reminding myself that if I was 750K off actual job growth, I should neither have a high degree of confidence that I can quickly flag a narrow cause for why the forecast was so wrong, nor should I remain close-minded to causes, even if they don't really ring true to me at the time. Jim Bianco, have you got an open mind as to what's caused this?
Yeah, I mean, I agree with a lot of what was said before, but let me throw out one other argument. The wage numbers were very high. You saw if you go back and you saw the ADP number was a miss earlier this week. The ISM numbers were a miss this week. The ISM numbers show prices paid was very high. So let's just cut to the chase. People are going to have to start paying more for labor, and we're going to have labor wage inflation. And the reason that they're not getting it now is that they're rationing their labor and they're not ready to step up and start giving increases. We've started to see anecdotally stories that you're getting paid to go to interviews, you're getting $300 signing bonuses if you're at the lower end of the wage scale. We're going to probably see more of that. We're probably going to have to see wages go up more. We're going to see inflation, and then we're going to start to see jobs come back. But right now, they're just not ready to pay enough to get people back to work. The shortage is also having a big issue too. Manufacturing was down 18,000. The chip shortage in the automobiles manufacturers being attributed to that. And transportation and warehousing lost 300,000 jobs. A lot of those jobs are idled because of the because of the supply constraints. Again, you resolve that by raising prices. Just start paying more for everything, and we'll start getting the supply chains moving one more time.
The solution could be the problem. Kathy, your response to that?
I think there's a lot of truth to that. I do think we're going to see higher wages, and I do think we'll see somewhat higher inflation. I don't think all of it will be transitory. I think there'll be some that's sticky because by and large, we're seeing a pretty major shift in the supply-demand dynamic. So I would agree. We'll start to see higher wages, which is the natural response to the shortage of supply of workers.
Jim Caron, your view?
Yeah, so I'm a little bit skeptical. I know we have about 8.2 million jobs that we're short right now. Those jobs need to come back, but will they all come back? Will we get all the pre-pandemic jobs coming back? A lot of corporations have changed. They've taken advantage of technology. Some jobs are just not coming back. So to some degree, there may also be a skills mismatch, meaning that the supply of labor coming in initially might be a little bit smaller. This could lead to a slower fall in the unemployment rate initially, but I do think that it could bring wages up, going forward. So that could be a point of inflation pressure, at least over the near term.
Jim Caron, you made 2 points. I want to pick up on the second point that you made a little bit earlier. You talked about the noise in the data. Goldman touched on this a little bit earlier in the week in a piece of research. The amount of dispersion between the data, the noise, the volatility, that range even before the print was 2.1 million at the high end, 700K at the low end. What I'm trying to understand now, with a big miss like the one we've just seen, and when you use the word noisy, how sensitive rates will be to incoming data in the weeks and months still to come. Jim Caron, less sensitive or more sensitive?
So I think it's going to be more sensitive, but the issue though here is that it's going to be more sensitive and attach itself more to what the Fed has been saying about being patient. So I think there's going to be a little bit of a reluctance for the market to embrace this high inflation thought process right now and have rates move higher, at least in the near term, very, very quickly. I think the markets may attach themselves to the Fed saying, look, it was probably right to be patient. But again, remember, noisy is noisy, which means that the May payroll number might be 2 million. I'm not making a forecast, but I'm just saying, I'm just throwing out there. It could be a significantly big number, in which case we're not going to be talking about the April number. So we have to be very, very careful about what time frame we're talking about.
Well, we got immediate reaction from the Federal Reserve. We heard from Minneapolis Fed President Neil Kashkari 10 minutes after the jobs report, 5 minutes even. Take a listen to what he had to say.
My friends on Wall Street, and I have a lot of them, I hear from them all the time complaining about the Fed's policies that are mucking up their trading strategies. I have zero sympathy because there are still 8 to 10 million Americans who want to work, who ought to be working.
It's Neil Kashkari there, the Minneapolis Fed President. Jim Bianco, for no reason at all, I turn to you, sir. Let's talk about this. The Federal Reserve and Neil Kashkari. No sympathy for anyone on Wall Street. That's okay. They believe there's a lot of work still to be done. We all agree with that. 8 to 10 million people still need to come back into the workforce. What remains to be seen, though, is whether a QE program at 120 billion a month at the moment, Jim Bianco, helps get that done.
Yeah, that's really the big question as to what kind of effectiveness that program is having in creating jobs in, let's call it the real economy. But I understand why a lot of people on Wall Street look at that 120 billion a month and say that it makes their job different or more difficult or maybe even easier, depending on where you are on Wall Street. But that's really the question that the Fed has to ask themselves. Are they helping to create jobs, or are they fostering an attitude about inflation that may come back and create more inflation and be counterproductive at the end of the day when it comes to trying to get us all back to full employment? I've not heard them articulate a good reason why, with the booming housing market, for instance, we still need to buy $40 billion worth of mortgages a month. Mortgage market seems just fine, and yet they continue to plow money into the mortgage market. And are they really helping the situation by creating jobs or potentially creating problems down the road?
Does it validate the Fed's current stance, Kathy Jones?
Well, I think so. I would agree that when and if they begin to taper, they'll probably start with mortgages because of the reasons cited. The housing market's in good shape, and they're a huge player in that market. But I would point out that QE periods have actually coincided with rising long-term rates. So even though they're taking duration out of the market and signaling a very dovish stance, that's almost fueled inflation expectations or growth expectations. And so it's hard to argue that what they're doing is really damaging in terms of fostering, this narrative of fostering, well, you have to do something else with your money. Sure, the zero interest rate policy is contributing to that, but I'm not sure that the QE is contributing to that to the extent that people think it is.
I'm often guilty of being seduced by the should-shouldn't debate with the Federal Reserve, and I always try and take it back to basics. It's the will-won't that matters here, Jim Caron. I wonder, after the payrolls report we had earlier this morning, whether it just takes the taper debate away from the June meeting, pushes it back to July again.
Yeah, I think it can be helpful in doing that. Again, it's also going to depend what the next payroll number also looks like. But I think the Fed's argument right here, we have to look through the lens of their policy reaction function. And one of the primary components is that they believe inflation is anchored. It's not become de-anchored. So they're willing, I think, to press this a whole lot further. The other component is financial stability. If they believe that their QE policies of $120 billion per month start to create, instabilities within the financial markets or potential for that to happen anytime near term, then I think that they also react. But at the moment, I still think that they believe that inflation's anchored and that they're going to probably stay the course. So I think it does push things back from June in terms of announcing tapering. My best guess is that they do it at the earliest at the Jackson Hole in August.
Jim Caron, Jim Bianco, Kathy Jones, sticking with us. We'll talk about the market in just a moment. The auction block next. The rush to junk continuing with yields plunging to fresh all-time lows. That conversation next. This is Bloomberg. Jonathan Ferro, this is Bloomberg Real Yield. It's time now for the auction block, where we kick things off in Europe with high-yield borrowers, borrowing more than $115 billion already, more than half the total raised in 2017's banner year, with 8 months still remaining on the calendar. Longer-dated high-grade debt regaining its luster in the US. Norfolk Southern selling $600 million of 100-year corporate bonds, the first to hit the market since 2018. And the borrowing blitz continuing in America as well in high-yield markets, the primary market heading for the busiest first half ever after pricing almost $200 billion already, with roughly 2 months still remaining. Kathy Jones, Jim Caron and Jim Bianco back with us. Kathy, I just want your view on credit right now. Spreads are super tight. I'm on repeat at the moment. Very tight, through the previous cycles tight. And there are a lot of people out there starting to pull back. And I caught up with Rick Reeder earlier. He was one of them who said he was raising some cash. What's your take on that, Kathy?
Yeah, particularly at the very low end of the credit spectrum, triple Cs, when you look at that, I mean, they are absolutely priced to perfection. So default rate of, say, 10%, and you're lucky to make zero on that trade if you don't lose money on that trade with the yield so low and spread so tight. So it's not that you pull back entirely, but I think that you have to pick your places pretty carefully. If raising cash would make sense to me. I feel like we're in this keep dancing until the music stops moment. You don't want to be the one left on the dance floor.
Jim Caron? I don't think we've got Jim Caron there. We're going to bring Jim Bianco in for more. Jim Bianco.
Yeah, I would agree with a lot of what Kathy said, that you got to keep dancing, you got to keep playing. And one of the things that might be driving all of this is what the Fed did last year, and that they came in and they purchased high-yield bonds. They purchased corporate ETFs. They sent a very powerful signal that they were there to make sure that if there was any disturbances in that market, that they would play along. And then at the end of the year, when the old administration pulled back on some of those programs, you heard the Fed complain about it as well, too. So there's this belief that, yeah, if you look at traditional fundamentals or traditional metrics in the high yield market or investment grade market, it doesn't provide you with a lot of comfort that you're paying up for a lot of those bonds. But then you've got a big player with a printing press behind you that's going to make sure that you come out whole in that market. So it's really making people reach for a lot of risk.
Yeah, and looking at the line coming out of M&G Investments, Bond Vigilantes is the handle on Twitter. This is the line. April saw 0 high-yield defaults for the first time in 2 years. At the same time, it was the 5th biggest month for high-yield issuance in history. Of course, a lot of that was refinancing. Bank of America saying rating upgrades are setting all-time records, and there's more to come. Kathy, it's hard to lean against that too hard.
Yeah, absolutely. Again, you've got everything on your side. You've got easy monetary policy, you've got expansive fiscal policy, and you've got an improving economy globally and domestically. It's hard to lean against credit right now. I just do think you have to be cautious about what risks you take.
Well, let's talk about whether you should be holding cash. I caught up with Rick Reeder at BlackRock, mentioned that just moments ago. Take a listen to what he had to say.
We definitely run in a lot of cash in the portfolios. We are, some of this exuberance argument and this overheating does give you a bit of pause. When the Fed puts 120 billion a month into the system, and then you get the Treasury pay down, the TGA drawdown, that puts another, depending on timing of how you look at another 500-600 billion over a quarter into the system. There's no question why the money's got to go somewhere, and this is part of why. That exuberance. It's not because people want to buy at levels they're buying at. It's because there's just too much liquidity floating around the system. We just cut all that out, rather sit in cash, and then take where we think there's upside convexity.
Just that piece there on the cash position, Kathy, I'd love your view on that. We're going into a really delicate next couple of months. The data could go either way, as we've seen this morning. Who knows? We've got to be humble about this moment. But most people assume that the taper debate is just around the corner, deeper into summer. Do you want a cash position going into that? Rick Reeder at BlackRock seemingly does. Do you?
If I thought that the Fed was going to announce tapering this summer, I would probably be building cash. I'm not convinced that they're going to announce it, this summer at Jackson Hole. They may push it back even further, depending on the data. They've talked about wanting to be patient. So I wouldn't be really increasing cash a lot at this moment, because it's not going to pay you much, and especially if you're depending on tapering to be the catalyst for a big move.
Jim Caron of Morgan Stanley back with us. I understand we've re-established that technical problem. Jim, just to bring you back in, Rick Reeder of BlackRock joined us a little bit earlier. He was talking about building up a cash position, maybe in the mid-teens going into summer. He's a little bit cautious, less constructive, let's say. Is that anything that resonates with you, Jim Caron?
I think in the mid-teens, it's probably a little bit high. Right now, we think that we're in a very stable yield environment. Curves are steep. There are places to look around, whether it's in credit or even in some emerging market spaces, or even in some of the developed markets where yield curves are steep. That I think, probably having a decent cash holding in the 5 to maybe 10% range would be okay. But I think anything beyond that might seem a little bit excessive, at least to me.
Jim Bianco, your reaction?
Yeah, I think that cash is a good place to be, especially if you think that rates are going up. Duration is something you want to hold less of, and naturally, as you move down the curve, you're going to wind up at the end of the curve, which means that you're going to have a little bit more cash. But I'd also agree with Kathy. If you're holding cash because you think the Fed is going to make some kind of an announcement about tapering at Jackson Hole, you might be a little bit disappointed. So if it's a part of a directional bet on rates, I would agree with holding more cash.
Well, let's talk about the move on rates. 30s are up 3 basis points right now. 10s are up about a basis point after the big move we saw early this morning. Before today, though, Kathy, we'd spent the whole week saying data's solid, better than, it's good, yet yields aren't going higher. Why not? Have we had an answer to that this morning?
Yeah, well, maybe the bond market really is the smart market, as people like to say, and maybe it was an indication that there were some doubts out there more than say was printed by the economists. But I would also say, look at 150 to 160, we're kind of fairly priced for an improving economy, but not a robust economy. And we have higher inflation expectations, but we need to sort of realize that inflation. So I think this is a resting place. I think if the Fed keeps policy aggressive, we will start to see the long end continue to move up in a steeper curve.
What are your thoughts on that, Jim Caron?
Yeah, so I agree with what Kathy's saying. I think the 150 to 160 area seems to be the center of gravity for now. I broadly put the range at about 1.4 to 1.8% in the 10-year. Look, I think what the market's looking for right now is the next catalyst to make rates move higher or lower, but I think the majority would believe that it's probably higher rates. But what's the catalyst? We already know inflation is going to print really big this quarter. We know that core PCE is probably going to 2.6%. Headline CPI might even go up to 3%. So all of this is baked into the cake. So If that can't get the 10-year yield moving higher right now, then what's the next surprise that's going to do it? Maybe it's the wage inflation that Jim Bianco, was discussing earlier that could be the catalyst that does it. But until we see exactly what that is, I think we can sit in this range for an extended period of time.
How many people would have said the curve would be steeper at the end of the day after the print we got this morning? If I told you what that number was going to be yesterday, in secret, of course, not that I knew the number, would you have thought that the yield on a 30-year would be up 3 basis points at the close of the day and the curve would be steeper? Jim Bianco, just a final word, please.
Yeah, no, that is a big surprise. And if I was to put my technical analyst hat on, I am a chartered market technician from way back when, this gigantic move down in yields in the reversal intraday smacks of some kind of an important day from a technical standpoint that we might have seen the low, at least since the March high in bond yields earlier today, and that we're in some kind of a reversal pattern. Still early days. We'll see what happens this afternoon, but it is an important pattern to pay attention to if we do wind up continuing to grind higher for the next couple of days, that it looks like some kind of exhaustion was hit with the bond market and a reversal's underway.
Hey, Jim, great to catch up, to get some final thoughts. Jim Bianco there of Bianco Research, Jim Caron and Morgan Stanley, and a tremendous friend of this program, Kathy Jones of Schwab. Still ahead, the final spread, the week ahead, featuring another massive stretch of Fed speak. That conversation up next. This is Bloomberg. I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the final spread. The week ahead coming up. Fed officials remaining in focus with Evans, Brainerd, Mester, Kaplan. Just some of the names speaking throughout next week. I bet you can't wait. President Biden hosting his first meeting with Republican and Democratic leadership on Wednesday. And finally, some big data points coming up, including US CPI and PPI. And closing out the week with retail sales on Friday. Wow, as we close out this week and look ahead to the weekend, the data, this market, over the last 12 months continues to humble all of us. That does it from New York. We'll see you next week at the same time, same place, 1 p.m. in New York, 6 p.m. in London. This was Bloomberg Real Yield. This is Bloomberg.